Why 90% of traders lose money. The psychology. Behind every losing trade path, there is a number that haunts every trading desk. Every online forum, every late-night chart session in a bedroom lit only by the glow of a monitor. 90%. 90% of traders lose money. Not eventually. Not occasionally. Consistently, predictably, almost mathematically. And here is the part that should stop you cold. It has almost nothing to do with intelligence. You could take the smartest person you know, a surgeon, an engineer, a professor of mathematics, sit them in front of a trading screen, and within 6 months there is a very real chance they would be down money. Not because they can't understand probability, not because they can't read a chart, but because trading is not a test of intelligence. It is a test of identity. It is a mirror, and most human beings cannot stand to look into a mirror that honest for very long without flinching. Stay with me, because what I'm about to walk you through is not another strategy video. This is not about moving averages or support and resistance, though we will touch on those later. This is about the war that happens inside your skull every single time you click buy or sell. This is about the brain you are carrying around right now. A brain built over hundreds of thousands of years for survival, for hunting, for avoiding predators, for staying inside the safety of the tribe, now being asked to make calm, rational decisions about leveraged currency pairs at 2 in the morning. It was never designed for that job. Nobody's was. Let me take you somewhere first. Imagine a man named Daniel, 34 years old, somewhere in Ohio, working a job he doesn't hate, but doesn't love either. One evening he watches a video of a trader who turned $2,000 into $200,000 in 8 months. The numbers flash on the screen. His pulse climbs a little. Something old inside him, something that has nothing to do with logic, whispers, "That could be you." Have you ever felt that whisper? Be honest with yourself for a moment before you keep listening. Daniel opens an account. He deposits $5,000, money he calls risk capital, though if you asked his wife, she might use a different word for it. He watches 3 videos on candlestick patterns. He downloads an app that shows him a green and red chart pulsing like a heartbeat. And then he does what almost everyone listening to this has done at some point. He takes his first trade. It wins. And right here, in this single moment, is where the story almost everyone has lived through quietly begins to turn dangerous. Because winning your first trade does not feel like luck. It feels like proof. It feels like confirmation that you are different, that you are one of the rare ones who simply gets it. The market, in its complete indifference to who you are, has just handed Daniel the most dangerous gift it can give a beginner. An early win. Here's something that might surprise you. In long-term studies tracking retail trading behavior, researchers have found that traders who experience an early win in their first weeks are statistically more likely to take excessive risk shortly afterward, and more likely to blow up their account within the first year than traders who start with a loss. The early win doesn't teach a lesson. It teaches the wrong lesson entirely. It teaches you that you are good at something you have not actually been tested on yet. This is the first crack in the foundation, and it happens to almost everyone. It probably happened to you, in trading or somewhere else in life that demanded patience you didn't yet have. Now follow Daniel forward 2 months. He's taken 30 more trades. Some win, some lose, but something strange starts happening in his mind that he doesn't fully notice. He remembers the wins in vivid, almost cinematic detail. The exact moment the green candle appeared. The feeling in his chest. The losses blur together, smudged, half-explained away. That one didn't count. The news moved the market. That one was bad luck. That one wasn't really my fault. This isn't weakness. This isn't stupidity. This is something psychologists call self-serving bias, and it lives quietly in every human brain, including yours, including mine. We are wired to protect our self-image at almost any cost, because for most of human history, feeling incompetent in front of the group meant exclusion from the group, and exclusion from the group meant death. Your brain doesn't know the difference between social humiliation in front of a tribe 40,000 years ago and the quiet shame of a losing streak today. To your nervous system, it registers as the same threat. You are not broken. You are running ancient software inside a modern, unforgiving environment that was never built with you in mind. But here is what makes trading uniquely cruel among almost every human pursuit. In most skills, effort and outcome are reasonably connected. Practice the piano 1,000 hours, you play better. Study for a semester, your grades likely improve. But in trading, you can do everything wrong and still get paid. You can ignore your stop loss, risk far too much, break every rule you wrote for yourself, and the market can still move in your favor, rewarding exactly the behavior that will eventually destroy you. And you can do everything right. Follow your plan with total discipline, manage your risk responsibly, and still lose. Because the market owes you nothing at all. This is the cruelest classroom on earth. It punishes discipline in the short term and rewards recklessness in the short term, often enough that most people never learn which one is actually correct until the damage becomes severe. Stay with me, because the next mistake changes everything. Back to Daniel. 3 months in now. He's had a rough week. 4 losing trades in a row, each one slightly larger than the last, because somewhere along the way he started increasing his size after losses, telling himself he needed to make it back. He's sitting at his desk at 11 at night, eyes red, coffee gone cold beside him. His account is down 18% from where it started. And then he sees it. A setup. Gold, the pair he's circled twice before on his chart. His pulse quickens. This is it, he tells himself. This is the trade that fixes everything. He doesn't check his plan. He doesn't calculate his position size the way he normally would. He just clicks. Bigger than usual. Much bigger. This moment has a name in trading psychology, and once you understand it, you will start seeing it everywhere, in your own history, in the stories of every trader, you know. It's called revenge trading, and it might be the single most destructive force in retail trading. More destructive than any bad strategy. More destructive than slippage, spread, or commission combined. Revenge trading isn't really about the market. It's about identity. When Daniel lost 4 trades in a row, some part of his brain didn't just register a financial loss. It registered a threat to his sense of who he is. I am someone who is good at this collided head-on with I am losing money, and the human mind cannot sit comfortably inside that contradiction for long. So it does what it always does when reality threatens identity. It tries to force reality to change immediately through one decisive, oversized action. Have you ever made a decision in trading or anywhere in life, not because the evidence supported it, but because you simply needed it to be true? You are not alone. This might be the most universal experience among traders across every country, every market, every era. It happened to floor traders in Chicago in the 1980s, shouting orders across pits thick with cigarette smoke. It happens today to a 22-year-old trading from his phone at 3 in the morning. The technology changes completely. The nervous system underneath, it does not change at all. Here's something most traders never notice, even after years in the market. Revenge trading and overconfidence are not opposites. They are siblings. Both come from exactly the same root, the same desperate need to control an environment that, by its very design, cannot be controlled. The overconfident trader riding a winning streak and the desperate trader chasing a losing streak are doing the same thing internally. They have both stopped trading the market in front of them and started trading their own emotional state instead. The chart becomes a screen onto which they project whatever they need to feel in that exact moment. Validation or vindication, and the second that happens, objectivity is already gone. Let's widen the lens for a moment. Because this story is bigger than Daniel. Picture Amsterdam, winter of 1636, a single tulip bulb, a flower that grows in dirt and dies in a season, is selling for more than a skilled craftsman earns in 10 years of labor. Merchants are trading their houses for bulbs. Farmers are mortgaging their farms. And here's the detail that should make the hair on your arms stand up. Most of the people buying tulip bulbs at the absolute peak of that mania were not foolish people. They were merchants and traders who understood commerce better than nearly anyone else in Europe at the time. They weren't ignorant of risk. They simply could not resist the pressure of watching everyone around them get rich. While they stood on the sidelines, this phenomenon has a name today. You already know it, even if you've never used the formal term. Fear of missing out. It is not a modern invention born from social media and crypto Twitter. It is one of the oldest forces in human economic behavior, and it has quietly bankrupted people in every century since money has existed. The tulip market collapsed in February of 1637, almost overnight. Fortunes vanished in days. 400 years later, the exact same psychological pattern plays out every single day in retail trading. Accounts around the world. A trader watches a coin, a stock, a currency pair surge upward, scrolls past dozens of people online celebrating gains, and feels that same ancient pull. Not logic, not analysis. Pull. For most human brains, the fear of being left behind is stronger than the fear of losing money. Sit with that, because it might explain more of your own history than you'd like. FOMO and greed, by the way, are not actually the same emotion, even though we lump them together. Greed says, I want more. FOMO says, I cannot bear to be excluded. An exclusion, to your nervous system, registers almost identically to physical pain. Brain imaging studies have found that social exclusion activates regions overlapping significantly with those activated by physical injury. When you watch other traders post winning trades while you sit there in cash, Your brain is not calmly weighing opportunity cost. It is, in a very real sense, in pain. And pain demands action. Any action, even the wrong one. Let's bring this back to something practical, because understanding the wound only matters if it stops you from reopening it. Every professional trader who has survived 10, 20, 30 years in the markets will tell you some version of the same sentence. Trading is 90% psychology and 10% strategy. New traders almost always hear that sentence, nod politely, and quietly believe the opposite, believing that if they just find the right indicator, the right entry signal, the psychology problem will somehow take care of itself. This is, without exception, the most expensive misunderstanding in all of retail trading. Imagine two traders given the exact same strategy. Same entries, same exits, same risk rules, identical on paper. 1 year later, one trader has grown their account by 40%. The other has blown their account to zero twice. Same strategy, completely different outcomes. What was different? Not the strategy. The human being executing it. This is the part almost nobody wants to hear, because it's far easier to believe success in trading is a technical problem with a technical solution, something purchasable. A course, a signal service, an indicator. It's far harder to accept that the obstacle between you and consistency might be sitting in the chair, staring back at you in the dark reflection of your own screen. Let's talk for a moment about Paul Tudor Jones. Not as hero worship, but because his story teaches something almost every beginner desperately needs to hear. Jones became one of the most celebrated traders in modern history, famous for profiting from the crash of October 1987. A single session when the Dow fell more than 20%. The worst one-day percentage decline in its history. What made him exceptional wasn't raw prediction. He has spoken openly about focusing on losing money before focusing on price, expecting to be wrong often, and structuring every position so that being wrong would never be catastrophic. Sit with that. One of the greatest traders in modern history built his entire approach not around being right, but around assuming he would frequently be wrong, and making sure wrong never meant ruined. Most beginning traders build their identity around the opposite need, the need to be right, and when the market proves them wrong, as it inevitably and repeatedly will, that need overrides every rational decision they already know they should be making. Stay with me, because there's a deeper layer underneath even this. Why does the need to be right feel so overwhelming? Why does a single losing trade sometimes feel less like a financial event and more like a personal attack? The answer lives in something called ego attachment, and it might be the single most important idea in this entire script. When you place a trade, you are not only making a financial bet, you are often, without realizing it, making a quiet statement about who you are. I am someone who can read this chart correctly. The moment the trade turns against you, your brain doesn't just process "I lost money." It processes "I was wrong about myself." And that second sentence hurts so much more than the first that most traders will do almost anything to avoid feeling it, including holding a losing position far longer than they should, moving their stop loss further away just to give it room. Refusing to close a trade every part of their training tells them to close. Asterisk, this has a name too. The disposition effect. It might be the most well-documented bias in all of trading research. Traders on average hold losers too long and close winners too early, almost the exact opposite of what good risk management demands, which is to cut losses fast and let winners run. It happens across every market, every country, every kind of trader, because the pain of admitting you were wrong is processed by your brain as a loss in its own right, separate entirely from the money. Asterisk. Have you ever held a losing trade far longer than your own rules told you to? Just hoping, just bargaining with a market that has no idea you exist? You are not alone. You are, in fact, behaving exactly the way the overwhelming majority of human beings behave when faced with the threat of admitting error. This isn't a flaw unique to you. It's a feature of being human, placed inside exactly the wrong environment to express that feature safely. Asterisk, in the late 1970s, psychologists Daniel Kahneman and Amos Tversky developed what became known as prospect theory, research that would eventually win Kahneman a Nobel Prize. Their core discovery was simple but enormous. Human beings do not evaluate outcomes in purely rational terms. We evaluate them relative to a reference point, and the pain of losing a sum of money is felt roughly twice as intensely as the pleasure of gaining that same sum. Losing $100 doesn't just cancel the joy of gaining $100. It hurts about twice as much. Asterisk, this single discovery explains a massive share of irrational trading behavior. It explains why traders cut winners short, eager to lock in pleasure before it can be taken away. It explains why traders let losers run, desperate to avoid the much sharper pain of a confirmed loss. The market doesn't need to be unfair to you. Your own brain's lopsided relationship with gains and losses is unfair enough on its own. Asterisk, this may surprise you. Professional trading firms know this research intimately, and they build entire training programs to override it. They drill risk management not as a suggestion, but as a non-negotiable mechanical process. Precisely because they understand the human sitting at the desk cannot be trusted to make that decision emotionally, in real time while a position is open. The rule exists because the brain cannot be relied upon in that exact moment. Asterisk, let's talk now about overtrading, because this one is quiet. It doesn't announce itself with one dramatic loss. It bleeds an account through 1,000 small cuts. Asterisk, imagine a trader named Sarah, based in Manchester. Disciplined, has done her homework, understands risk management in theory, but she has one habit she doesn't recognize as a problem. She trades almost every day, sometimes 5 or 6 times in a session, because sitting and watching a chart without acting feels unbearable to her. Boredom to her nervous system feels like a problem demanding a solution, and the only solution she knows is action. Asterisk, but here's what Sarah doesn't realize. The professional traders she admires often take far fewer trades than she does. Some of the most successful traders in history built their careers around patience so extreme it would feel almost painful to a beginner. Waiting days, sometimes weeks, for one setup that meets every single criterion, and doing absolutely nothing in between. Asterisk, doing nothing is a position. Doing nothing is, very often, the single most profitable action a trader can take. And it is also, for most human beings, the hardest action to execute, because our brains associate activity with productivity and stillness with failure. Sarah isn't overtrading because she's reckless. She's overtrading because stillness feels somewhere deep and ancient inside her. Like giving up. When was the last time you took a trade, not because your plan told you to, but because you simply couldn't stand to sit there and do nothing? This is the real reason coming into focus now, the thread connecting everything we've walked through so far. The early overconfidence, the revenge trading, the FOMO, the disposition effect, the overtrading. These are not separate problems requiring separate fixes. They're all expressions of one underlying force: the inability to tolerate discomfort and uncertainty without taking immediate action to resolve it. Trading is one of the only professions on earth that explicitly rewards the ability to sit inside discomfort without flinching. The market does not offer guarantees. It does not care about your hope, your need to be right, or how badly you need this month's rent covered. And the traders who survive long-term, the actual minority who do make consistent money, are not the ones with the most sophisticated indicators. They are the ones who, through painful repetition, trained their nervous system to stay calm, while everyone else in the market is panicking, celebrating or bargaining. Stay with me. Because in part 2, we go even deeper into decision fatigue, into the locus of control that separates traders who blame the market from traders who finally start improving, into real historical collapses involving the smartest minds in finance, and into exactly what changed inside Daniel a year after his worst night. The night that nearly ended his account and almost ended his trading career before it had really begun. Why a year after his worst night? The 11 p.m. revenge trade that cut his account nearly in half. Daniel sits in front of his screen again. But something about the way he sits is different now. His shoulders aren't tight. His jaw isn't clenched. He's not waiting for the chart to tell him who he is. He's simply watching it the way you'd watch weather roll in. With curiosity instead of desperation. I want to walk you through how he got there, because the path matters more than the destination, and because somewhere in this path you're very likely going to recognize yourself. After that brutal night, Daniel did something most traders never do. He didn't quit, and he didn't deposit more money to chase the loss. He stopped. Not forever, just long enough to ask an uncomfortable question he had been avoiding for months. What is actually happening inside me when I trade? This question sounds simple. It is not simple. It requires a kind of honesty that most people, in any area of life, spend their entire lives avoiding. Because honesty about your own patterns means admitting that the story you've been telling yourself about who you are might not be entirely true. Daniel started keeping a journal, not just entries and exits, prices and percentages, but his emotional state before, during, and after every single trade. Tired or rested, calm or anxious. Trading because the setup was there, or trading because he simply couldn't stand to sit still. Within a few weeks, a pattern emerged that he could no longer pretend not to see. Nearly all of his worst trades happened either late at night, when he was tired and his self-control was thin, or immediately after a loss, when he was emotionally charged and hunting for validation instead of opportunity. His best trades, by contrast, were almost boringly mechanical. Calm, taken during his planned hours, following his rules without negotiation. This is something most traders never notice about themselves, because they're too busy studying the chart to ever turn that same intensity of focus inward, onto the actual trader making the decisions. Here is something worth sitting with for a moment. The chart is rarely where your worst losses actually originate. Your nervous system is. Let's talk about something psychologists call decision fatigue, because it explains a huge share of late session and late career mistakes that most traders wrongly blame on bad luck or bad strategy. Every decision you make throughout your day, what to eat, what to say in an email, how to respond to a frustrating coworker, draws from the same limited pool of mental energy. By the time many traders sit down at night to trade, after a full day of decisions already spent, they are operating on a depleted reserve of self-control, the exact resource required to follow a trading plan rigorously when emotions start running hot. This isn't a coincidence. It's biology. Willpower behaves like a muscle that tires with use, and trading decisions made late at night, after a long day, are statistically far more likely to deviate from a stated plan than decisions made fresh. With a clear and rested mind, I want you to actually think about this, not just let it pass by. What time of day do your worst trading decisions tend to happen? What emotional state are you usually in right before a trade you later regret? If you've been trading for any length of time, you already know the answer. You've probably known it for a while. You just haven't wanted to look directly at it. Now let's talk about something that ties all of this together. A concept that, once understood, genuinely changes how many traders relate to the market for the rest of their lives. It's called the locus of control. Some traders operate with what's known as an external locus of control. They believe their results are mostly determined by outside forces. The market makers, the algorithms, the news, manipulation, bad luck. When they lose, it's because the market was rigged against them specifically. When they win, it's because they finally found the right setup, almost as if luck had nothing to do with it. This way of thinking feels protective in the short term, because it shields the ego from blame, but it is absolutely fatal to long-term growth. If your results are determined entirely by forces outside your control, there's nothing left for you to learn or improve. You become a permanent passenger in your own trading career, watching the road go by without ever touching the wheel. Other traders operate with an internal locus of control. They understand that while they cannot control where price moves next, they have near total control over their own behavior, their position sizing, their entry criteria, their patience, their willingness to walk away after a loss instead of chasing it into a second, larger loss. This shift from blaming the market to examining your own behavior is, according to nearly every professional trader who has ever spoken honestly about their own development, the single most important turning point of their entire career. Not a new indicator, not a new strategy, a change in where they located responsibility for their results. Stay with me, because we're getting close to something important now. There's a reason this entire script keeps circling back to psychology rather than charts, rather than the technical analysis content you can find in 10,000 other videos. The technical side of trading, while genuinely important, is learnable in a matter of months by almost anyone with reasonable intelligence and consistent study. Support and resistance, trend lines, basic price action, liquidity concepts, order blocks, breaks of structure, these are skills. And skills can be taught, practiced, and acquired through repetition like any other. But psychological discipline cannot be downloaded. It cannot be purchased inside a course. It can only be built slowly through the genuinely uncomfortable process of watching yourself make the same mistake more than once, feeling the consequences land and choosing again and again to respond differently than your instincts are demanding in that moment. This is why so many traders can correctly identify a textbook perfect setup and still fail to execute it properly. The knowledge was never the actual bottleneck. The execution under real emotional pressure was always the bottleneck. Let's bring in one more historical story, because it illustrates something crucial about the relationship between knowledge and behavior. And it involves some of the most respected minds in modern finance. Long-term capital management was founded in 1994, staffed with some of the most brilliant minds in the financial world, including 2 Nobel laureates in economics. Their models were mathematically sophisticated beyond almost anything that had existed before in the hedge fund world. For years, they generated extraordinary returns, the kind that made other firms on Wall Street nervous just watching from the sidelines. Then, in 1998, following a Russian financial crisis, their models had assigned an almost impossibly low probability. The fund collapsed with such speed and scale that it threatened to destabilize the entire global financial system, requiring a coordinated rescue organized by the Federal Reserve. Itself. The lesson here isn't that intelligence doesn't matter. The lesson is that no model, no matter how brilliant, can account for every possible outcome, and any approach to markets that doesn't build in genuine humility about the limits of prediction is eventually going to meet an event it simply cannot survive. The smartest people in the room, armed with the most sophisticated mathematics available at the time, were not exempt from a fundamental truth. Markets are larger, messier, and more unpredictable than any single model can fully capture. If genius-level intellect couldn't substitute for risk discipline, what makes any of us think our gut feeling about a chart pattern is enough on its own? Let's go back to Daniel one more time, because I want you to see what actually changed. The part underneath the journaling and the discipline, the part that's harder to put into words. A year after his worst night, Daniel is not rich. I want to be honest with you here, because this whole script has been built on honesty rather than hype. He has not turned $5,000 into $500,000. His account has grown slowly, unglamorously, by a little under 30% over 12 months. Through strict risk management, a written plan he actually follows, and a level of self-awareness about his own emotional triggers that took months of uncomfortable, often boring journaling to develop. But here's what's actually different about Daniel now. The part that matters more than any single year's return. He no longer feels his identity rise and fall with every individual trade. A loss doesn't threaten who he believes himself to be, because he has separated the outcome of any single trade from his self-worth. understanding instead that his job is simply to execute his process correctly and let the statistics play out across a large enough sample of trades. He has learned to think in probabilities instead of certainties, to see each individual trade not as a referendum on his ability, but as one data point inside a much longer sequence that only makes sense when you stop staring at any single point, too. Closely dot, this is the actual transformation that separates the small minority from the overwhelming majority. It is not a secret indicator. It is not a proprietary algorithm sold for $2,000 inside some online course promising guaranteed returns. It is the unglamorous, repetitive, deeply uncomfortable work of becoming someone who can sit calmly inside uncertainty, who can lose money according to a plan without spiraling into revenge, who can watch other celebrate gains they missed without abandoning their own discipline, and who understands, at a level deeper than intellectual agreement, that the goal was never to be right on any single trade. The goal was always to survive long enough with discipline intact, for the math of a sound process to play out properly over time. Let's talk practically for a moment now, because understanding the psychology without understanding the structure that protects you from it leaves you informed but still exposed. Risk management is not, as many beginners assume, a boring technical afterthought you bolt onto a strategy once everything else is figured out. Risk management is the physical, mechanical expression of psychological discipline. It is the bridge between knowing what you should do and actually doing it, when every emotional instinct in your body is screaming at you to do something else entirely. Consider position sizing for a moment, something so many beginning traders treat as an afterthought, often risking 5, 10, even 20% of their account on a single trade simply because the setup feels unusually strong. Professional risk management generally caps risk per trade somewhere between 0.5% and 2% of total account capital. This isn't because professionals are timid or overly cautious. It's because they understand a mathematical truth most beginners never fully internalize. It is entirely possible to be right on the majority of your trades and still lose everything if your position sizing is reckless on the trades that go wrong. A string of just 5 or 6 oversized losing trades, the kind of streak that happens to every trader eventually, can wipe out an account that took months to carefully build, while a trader risking 1% per trade could survive 20 consecutive losses in a row and still have the vast majority of their capital fully intact. This may surprise you. The math of survival matters more than the math of being right. A trader who wins 50% of the time with strict, disciplined risk management will, over a long enough timeline, almost always outperform a trader who wins 70% of the time with reckless position sizing, because the reckless trader only needs one truly bad day, one black swan event, one piece of unexpected news, to be eliminated from the game entirely. And you cannot make money in a market you're no longer participating in, no matter how good your win rate used to look on paper. Let's talk about what professional traders actually do differently, beyond the risk principles we've already covered, because I want to leave you with something genuinely practical, not just something philosophical to nod along to Asterisk, professional traders almost universally separate the decision to enter a trade from the emotional experience of actually being inside that trade. They do this primarily through pre-planning. Before they ever click buy or sell, they have already determined their exact entry point, their stop loss, their take-profit target, and their position size, based on rules decided in a calm, rested state, long before the emotional pressure of a live position even existed. This means that once they're in the trade, there's almost nothing left for them to decide. The decision was already made, calmly, in advance. All that remains is execution, according to a plan built by the rational mind rather than improvisation by the emotional mind in the heat of an open position. Asterisk, this single shift, planning everything before entry instead of during the trade, eliminates an enormous percentage of the psychological traps we've walked through across this entire script. You cannot revenge trade a plan you set calmly the night before, with a clear head and no open position pulling at your emotions. You cannot let a loser run indefinitely if your stop loss was already placed mechanically at the moment of entry. You cannot let FOMO push you into an unplanned trade if your rule is simple and absolute. No plan, no trade, regardless of how compelling the chart looks in that exact moment. Asterisk, I want you to think about this, not as advice you'll nod along to and forget within the hour, but as something you actually carry with you the next time you sit down in front of a live chart. The market will always offer you 1,000 reasons to deviate from your plan. It will show you a setup that looks almost too perfect, right after you've already taken your planned trades for the day. It will show you a painful loss and quietly whisper that just one more trade will fix everything. It will show you everyone else online celebrating a move you missed, and it will make staying disciplined feel, in that exact moment, like the worst decision in the entire world. Asterisk, this is the test. Every single day and every single market, this is the actual test you are taking. Not can you read a chart. Almost anyone can learn to read a chart with enough study and enough screen time. The real test is this. Can you do the boring, disciplined, unglamorous thing over and over again for months and years, even when your emotions are screaming at you to do something else entirely? Asterisk, let's go back even further in time for a moment, to the dot-com bubble of the late 1990s, because it illustrates something crucial about the relationship between knowledge and behavior that even the most credentialed professionals are not immune to. Asterisk, during that period, some of the most sophisticated, highly educated investors in the world, professional fund managers with decades of market experience behind them, poured enormous sums into internet companies with no profits, sometimes no revenue at all, simply because the upward momentum of the market created a psychological pressure that overwhelmed their own professional training. When the bubble began collapsing in March of 2000, trillions of dollars in market value evaporated, and it wasn't only retail investors who suffered. Professional, credentialed money managers, people who understood valuation models intimately, fell victim to the exact same FOMO and herd psychology we discussed earlier with the Dutch tulip mania. Almost 400 years apart, separated by centuries of technological progress, and yet behaviorally almost indistinguishable from one another. Asterisk, this should tell you something important, something worth really absorbing rather than just hearing and moving past. The problem was never a lack of intelligence or a lack of access to information. The problem, then and now, has always been the human nervous system's relationship to uncertainty, social pressure, and the fear of being left out of something everyone else seems to be profiting from in real time. Asterisk. Let's bring this all the way back to you now, because everything we've walked through, Daniel's story, the tulip mania, long-term capital management, the dot-com collapse, Paul Tudor Jones, prospect theory, the disposition effect, decision fatigue, locus of control, has all been circling around one single truth. Asterisk, the market does not care about your hopes. It does not care about your need to be right, your rent payment, your ego, or how badly you want this to work out for you. It is, and always has been, simply a reflection of millions of human decisions, made by millions of nervous systems just like yours, all wrestling with the exact same fear, greed, hope, and uncertainty that you wrestle with every single time you open your charts. Understanding that, really understanding it, is not discouraging. It is, if anything, liberating, because it means the market was never your enemy. It was never rigged specifically against you. It was simply indifferent, and your job was never to defeat it. Your job was only ever to defeat the version of yourself that wanted to act before thinking, that needed to be right more than it needed to be disciplined, that mistook activity for progress and certainty for safety, inside a game that offers neither one. Asterisk, 90% of traders lose money. But that number was never really about market knowledge. It was about how many people could face that mirror, the one we talked about at the very beginning of this journey, and keep looking, keep adjusting, keep choosing discipline over drama, week after week, year after year, long enough for the math to finally turn in their favor. Asterisk, the question isn't whether the market will test you. It will, relentlessly, and it will use every weakness you have, every insecurity, every flicker of impatience, against you again and again, until you either learn or you leave entirely. Asterisk, the real question is who you'll have become by the time the test is finally finished. Asterisk, and that, more than any chart pattern, more than any indicator, more than any famous trader's quote pulled out of context, is the real story behind every single losing trade, and behind every single trader who eventually, quietly, stopped being part of that 90%. Asterisk. If there's one thing I want you to carry away from everything we've covered, let it be this. The market was never going to hand you certainty. It never offered that to anyone, not to the genius fund managers of long-term capital management, not to the merchants of Amsterdam trading their houses for flowers, not to the smartest investors of the dot-com era, and it will not offer it to you either. What it offers instead is a long, repetitive, often boring opportunity to practice staying calm inside chaos, to practice choosing process over emotion, again and again, until that choice stops feeling like a fight and starts feeling like who you simply are. Asterisk. That's the whole game. Not predicting the future, just becoming someone who can be trusted with their own decisions when the future refuses to cooperate.